Hello and welcome. You're watching the newsroom on ET Now. I'm Anisha Jain, and the day today is not so good for the bulls, and I say that because we have been consistently trending below the mark of 19,600. Not a very smackdown kind of move, but nonetheless we are 40 points lower, so that buying on dips doesn't seem to be materializing, at least as of now. What's bouncing back is the PSU banking space as well as the entire financial space. So it started off a bit tempered, but now it has picked up pace. So that index are standing tall with a gain of around 1.5%. What's on the back foot is metals. No surprise given the fact that data from China was very weak, missed the expectation on all counts, and that's the reason the metal space is on the back foot, and so is the entire real estate pack. Talking about stock specific action, Gland Pharma definitely deserves mention because of the 20% up move that we have seen post the upgrade. You also have stocks like Sera, VIP, Suntech, which are doing okay in the trading session. Ditto can be said for Manappuram. On the losing side, however, PB Fintech is coming under a bit of pressure after its earnings. Zomato is seeing a bit of a cool off, and then you have result reactions for the likes of Electra Green Tech, Maxell, Sobha. So a lot of buzzers really in the trading session. But the big question is, where are we headed from here on? Because 19,600 has been sticky. Do we scale that mark of 20,000 or not soon? That's the question we are posing to Sushant Bhansali. He's the CEO at Ambit Asset Management, joining us on the show. Sushant, hi. Thank you so much for making time and speaking with ET Now. Let's begin by getting your market perspective. Do you think that we are getting a bit toppish and that's why a bit of consolidation and sideways move? Or do you see more legs to the rally?
Yeah, so the rallies, I would say, just started. We had almost 1.5 years of lull between September 21 and March 23. And we have now seen a new rally starting from April this year. So the rally has just started probably. If you look at the previous rally, just looking at Nifty, pre-COVID, we were slightly short of 12,000 and we peaked out to more than 18,000 by September 21. So from that perspective, the next, I would say, top of the market seems to suggest should be about 27,000 Nifty in 2 or 3 years. So the rally has just started. Of course, the rally started with a big bang. In just 3 months, we moved Nifty from about 17,000 to 19,500. So almost 20% sort of returns. But the rally is here to stay. There will always be short-term volatility, and at times market will be consolidating at a range, which it has been for last 1.5 months. We are between 19 and 20 or thousand, yet to peak out to 20,000, but still between 19 and 20, it's almost 1.5 months. So, but we expect that this rally to continue for a long period of time from here on.
Okay, so the conviction is clear. The rally is going to continue for a long time. We had already seen a big sprout per se from March lows to June onwards, a bit of a sideways move, but the overall long-term rally really continues. That's the view coming in from Sushant. But let's break it down, Sushant, in terms of the move that we have seen in the last 3-4 months. It was largely led by the outperformance in mid caps and small caps, while large caps are on the back foot. Whether you call it on account of the corporate restructuring, etc., which was underway in a lot of them. But going forward, do you see strength continuing with the broader markets, or do you see leadership coming back to the large caps as well?
Yeah, so historically, if you've seen the small cap companies and mid cap companies, given their size and base, will always grow faster than the large cap companies, and thereby returns in those companies ought to be higher than them. Last 6 months, it has been quite bullish on the small cap and mid cap segment, naturally compared to large caps, but they were rogered down that much as well prior to that. So between September 21 and March 22, while the index was sort of in the same range, but the large caps, but the small caps, I would say, which peaked out in January 22, they got really hammered out, and it's more of a mean reversal and catching up in the past 2 or 3 months. So we expect that from here on also, while Nifty might go another 25, 30 odd percent in the next 2 or 3 years, the small and mid caps will probably deliver much more than that, given the size and the opportunity set which they bring to the table in terms of the Indian economy.
Okay, so broader markets are likely to outperform, at least on an absolute return basis. But Sushant, let's break it down sector-wise as well. One common theme that seems to be coming out is urban discretionary. The premium segment, whether it's watches or cars, premium real estate, even urban discretionary in terms of hospitality, aviation, etc., has been booming. What's the best way to play this theme, you believe?
Yeah, so naturally, consumer discretionary, as India is growing and as our economy is now from 1 trillion to has crossed 3 trillion, and sooner to 5 and then to $10 trillion in next few years. So probably in 2030s, we'll see India going towards 10 trillion also. A large part of the bottom of the pyramid has been moving up the poverty line. And between 1 and 3 trillion, I think a large part moved from less than $100 to about $500 sort of earning profile. And that segment will go to 1,000 and 1,500 and 2,000 in the next few years. So once you are satisfied with your basic needs of roti, kapda, and makan, you will definitely reach out and spend more on probably discretionary spend, and which is where the opportunities lie. And it's across, and in these segments specifically at the, I would say, the entry range, right? Whether it's footwear or apparel or probably even luggage, etc. There are very few companies who are able to scale up and create a pan-India brand. If you look at any category, there are not more than two or three players which corner about 80-90% of the profit pool of these industries. There's lots of unorganized, and that unorganized is moving to organized side. And you just need to, I would say, stay behind the sector leaders or the challengers in each of these sectors. Look at their ROCs and look at their growth profile and the strength of the balance sheet. And you can't, I would say, miss making money.
Sure, point taken. Urban discretionary seems to be a secular trend. But Sushant, the other consensus buy is financials. But I want to ask you, what is that underrated sector or a contra bet that is worth taking at this point of time where the risk reward is really favorable?
So if you look at, I think banks have not participated that well post COVID, right? So I would, and the growth is in, I would say, good sequence. IT is another sector, but there probably the expectation of growth have been quite sluggish, and artists participated a lot post COVID in the first year and a half. So from a valuation perspective, both banks as well, banks, NBFCs and IT are really comfortable, but the growth momentum in the banks and IT and banks and NBFCs is much beyond ITs of today.
Okay, so you're still saying that there is more earnings, legroom available despite the run-up that we have seen in the financial space. How are you placed on IT as well as the new age tech platform world? Because after Zomato turning profitable, there's a renewed interest in all of them.
Yeah, definitely. As interest rates, I would say, start coming down, and your DCF will suggest to take a lower equity capital cost. The valuations of these back-ended cash flow businesses will become, I would say, probably more investable from an investor's perspective. But still, the new age businesses, many of them will throw lots of cash in the probably after 2 or 3 years. So from a retail investor perspective, I would say that better to bet in the IT names and at this point of time compared to new age businesses today.
Okay, so the valuation is favoring the traditional IT companies and not necessarily the new age tech, given, of course, they've recovered quite a bit from the lows as well.
Yeah.
Sushant, last question before I let you guys go is on autos. Specifically, the two-wheeler space is seeing a lot of disruption. Last year was all about, the SUV, SUV market in the passenger vehicle and the EV transition. This year, it's all about the premium biking, and we are seeing this fight of Hero versus Eicher versus Bajaj. Which do you think will come out triumphant?
Yeah, so whenever a new segment gets picked up, and you can look at different industries, not just autos, but you look at how it played out in the innerwear segment a few years back, or how it played out into tile segment, yeah, I think few years back. Similar segment we are noticing in the two-wheeler industry, where the premiumization story, which few of the players have been leading for last 10-15 years and have created the segment. Suddenly everybody is interested, but you look at the core of the business and the large part of the value of most of these companies coming from their premium portfolio, how big or small it is. And you'll realize that for players who have already a large premium segment, which is bulking up probably about 80-90% of the revenues, those will become much larger and become more beneficiaries of this premiumization story compared to entry level bike players who are now transiting into the premium, because the premium bike segment will still remain a very small part of their portfolio for the next 3 or 5 years at least. So the bulk of the value will still be from the entry level bikes and scooters for these players.
Okay, so the bread and butter is not changing. It's going to be the entry level, volumes which are going to be still mass appealing. On that note, Sushant, we let you go. Appreciate you making time for ET Now today.
Thank
But
you.
time now to take a breather on the show as well. As we do that, listen.